Bruce Campbell joins me now. He's portfolio manager at Stonecastle Asset Management. Bruce, welcome back.
Yeah, thanks for having me back. It's been a few weeks.
Yeah, it's certainly interesting times we live in. Bruce, let's start the conversation with what's your take and expectation of the performance of the cannabis sector in the midst of this financial crisis?
Well, certainly it's going to be challenging. If you look at the fact that the banks and investments like that have gone a risk off, you certainly wouldn't expect investors to be flooding into cannabis stocks just with the high risk nature of and the high volatility that they typically had. That is even more so when we see the markets at sort of historic extremes.
So then it's safe to say that despite the fact that pot stock prices are cheap, there's no reason to believe that they have reached a bottom at this point, is there?
No, I wouldn't necessarily say that. I mean, obviously we would probably need the overall market to have formed a bottom as well. But if it has, then that's where the opportunity will lie in cannabis, and it depends on your time frame.
Okay, so your firm is not solely interested or invested in cannabis. What other sectors do you participate in, and where do you see opportunities in this general climate?
I mean, we invest across the spectrum, so we'll look at really any sector, and I mean we're as shocked as probably a lot of people with the extremes that you've seen from a selling standpoint and some of the opportunities that are created there. So, just as an example, we've been picking away at some of the banks here. We're really surprised at the yields that they have. And, if you can lock in these types of yields, that you're getting a Canadian bank that, the price is going to bounce around, but you're getting paid that dividend payment, which in the bank's case is, most of them are fairly secure. You don't have anything to worry about. Then you have capital appreciation upside. We've seen some technology sector areas that, stocks that have really been beaten up and dropped off. Obviously the oil and gas goes without saying how bad it's been. We haven't really stepped into oil and gas at this point in time, but it's at some point in time going to become this monster trade. When that is, I don't know. Probably we need to obviously have the commodity market for oil and gas right-sized, both from a supply perspective, but also from a demand perspective. And right now, they're both going in the opposite directions. But when they changes, there's going to be huge opportunities. You could see stocks that probably double or triple and not even be close to the levels that they started the beginning of this year.
So the banks are offering improved yields because they are trying to maintain the support that they see in the financial markets, or is there some other mechanism at work here?
No, it's a function of their dividend yield. So they've obviously kept their dividend yields where they are, and at the same time the stock price is sold off. So
I see. Relatively,
as an example, like Commerce is trading with a over 7% yield, and many of the other banks are trading in the sixes. So if you think about the fact that that's a dividend and you get a tax credit on that dividend, your after-tax cost is or your after-tax equivalent in interest is significantly higher than that yield. And then you think like, well, I can't even get on an interest basis a yield is that high. You do have some volatility still. It's not like buying a GIC at the bank where that your principal is always going to be protected. But what is that the banks have been very resilient as far as paying their dividends, even during the 2008 financial crisis, and that's not what this is. And then the stock price can also appreciate over time, and they're also great dividend increasers as well. So they're always increasing their dividend, sort of year to year. That is huge advantage for anyone that's looking for income.
Sure. Do you think that the willingness to continue paying dividends at that rate will be impacted negatively should markets continue to demonstrate weakness?
Well, I mean, obviously that's a potential that you have to look out for. But if you go back to 2008, the banks didn't touch their dividends, and there was a lot more concern at that point in time about the global financial situation. This is completely different. This is really a shorter term event. Do we know how long that is? No. And I mean, that's what the market's concerned about. Is this a 2 month? Is this a, 2 year slowdown? We don't know how much and how deep it goes, but it's completely different than what we've seen in the past, where it was Fed induced. This is strictly just because of this coronavirus and the shutdown of the world to try to stop the virus. It's hurting economic activity. The banks will bounce back, and for the most part, their capital ratios are in line. There was a lot of people obviously looking at oil and gas this week with a lot of the oil and gas loans, but really for the most part, the Canadian banks are under 3% of their total loans are in oil and gas, and some of them are in the low ones. So it's not a big percentage of their loan book.
Mm-hmm. So I guess if Russia and Saudi Arabia were to settle their differences, we could expect to see a rebound in the oil sector easily.
Well, that's step one. I mean, and then obviously step two is on the demand side of things. Demand from a short-term perspective will have dropped off significantly. People aren't traveling. They're not. The factories have been shut down. All of that's going to have an impact. But that should be, a short-term event. That demand probably, for the industrial capacity goes back fairly quickly. For the travel sector, it's going to be probably a slower ramp up as people feel comfortable that they can travel and they don't have to worry about catching the virus.
Right. And by all indications, if we look at China's apex of rates of infection and the continuing decline in rates of infection and mortality, it looks to me like there is no reason to think that the coronavirus issues currently gripping the later stage countries that have been involved beyond summer.
Yeah, you sort of think that the numbers could, peak in the next probably, 4 to 6 weeks, and then at that point in time they would start to have that decline. And so you're right, you're sort of looking at somewhere in the sort of the summer time frame. How long we stay, kind of without events and without, sort of the recommendation to travel, that's what we don't know. And I mean, that'll all depend on how fast this all gets shut down, right? If everyone sort of is most strict and adheres to all the rules, then it has no one to jump to and no one to spread to, and then once it's run its course on the people that have it, it doesn't get to anyone else.
Right. So then it sounds to me like there's a hell of an opportunity coming up here, and that if you did not get completely wiped out in the meltdown that has occurred, it's good to be in cash and wait for the signal that the market's going to reverse. I mean, convergence of a few positives like the oil crisis being resolved, the coronavirus running its course, could easily catalyze a major reversal of fortune.
Yeah, especially with the stimulus that's going to come at this market. We're seeing monetary stimulus. We'll probably start to see some fiscal stimulus as well. And then even if you were an investor and you were in the market, and maybe you take a look and you start looking for opportunities. So let's assume that you had a diversified portfolio, but that maybe included an underweight position in something like the banks. Well, you could sell something else that's down and replace it with a bank, and you're going to high grade your portfolio. So there's always that opportunity, especially after you've seen really everything sold off as hard as it has.
Mm-hmm. So then, in terms of the degree of severity of this particular downturn relative to 2008, is it your opinion that this is more or less going to be much more just market related, whereas the 2008 crisis was very much economically driven as a result of the excess liquidity and the collapse of asset-backed securities and mortgages? Do you think this is just more like a technical glitch then caused by the coronavirus?
Well, certainly people are going to look back at this and talk about the coronavirus crash of 2020, and it's going to be related to 1929 and 1987 as far as what happened. From an economic standpoint, that's the thing the market's most concerned of. And of course, everyone who lived through 2008 knows how bad it can get. And so, they're doing the extrapolations and saying like it's going to get worse than we think, and when it does, I don't want to own stocks, and so they were just exiting. Obviously the opportunity is that if this thing rebounds, and when I say this thing, like the virus gets shut down or slowed down, or the other thing is people sort of look at the severity of what it is to get the virus and how we can protect the people who are most at risk. Then at that point in time, you could see that excess demand that's been taken out of the system come back in. Plus, you have stimulus from an economic standpoint, from a market liquidity standpoint, that could really fuel this thing higher. And that, is that later in 2020 or is that out in 2021? That's what no one knows. But when it happens, it could be really significant.
You bet. All right, Bruce, we'll leave it there for now and come back to you next week. Thanks very much for joining me again today.
Okay, thanks a lot. Have a good weekend.
You too.